Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show out there dedicated to the corporate action reshaping markets. Romaine Bostic today in for Danny Berger. And today on Bloomberg Deals, some big ones. The LA Lakers reportedly being sold for more than $12 billion. And the buyers, Josh Kushner and Bob Iger. We're going to have more on that in just a moment. And we're going to catch up with Jim Chadwick, president over at Ancora Alternatives. He's going to be joining us for an exclusive interview as he unveils a new plan in his fight with H.B. Fuller. And Alex Cooper, her Unwell media company, getting backing from a major Hollywood investor. Why the call her daddy parent company might now be valued at $500 million. Well, let's start with basketball and the Los Angeles Lakers. Bloomberg senior sports reporter Randall Williams has been covering this story. Randall, a $12 billion deal said to be in the works for Bob Iger and company to take control of this franchise. What do we know?
Well, it's a shocking deal, to say the least. We had Mark Walter bought the team last year for a $10 billion valuation. To see that flip in less than 18 months to $12.5 billion is absolutely insane. Joshua Kushner and Bob Iger were interested in Las Vegas for an NBA expansion team. They're in the running for the bidding process for that. But obviously, they have abandoned all interest and, of course, are now the owners or soon to be the owners of the Los Angeles Lakers if the NBA Board of Governors approves the deal.
Well, that gets to the question here. Will they? I mean, what exactly is the transactional value here? I was under the impression that Kushner and his folks were actually looking more at an expansion team. Why this pivot? What actually happened?
Well, it's my understanding that Joshua Kushner and Bob Iger were well into the expansion bidding process, and the numbers were just getting high, is what I've been told. And so before they continued on with their journey of owning the potential NBA expansion team in Las Vegas, they canvassed and asked around to see what was available for sale. And I don't believe that Mark Walter really had any intention of selling, but when you add $2.5 billion, that's more than Laker revenue, I would imagine, for this season alone. You add $2.5 billion onto a transaction that was simply $10 billion last year. And if I was Mark Walter, I would have said yes, too.
I know we don't have a whole lot of details on exactly how this will actually go down, but do we have any sense of what the financing will look like for this? I mean, this isn't all just coming out of the pocket of Thrive and Bob Iger, I assume.
No, there's not a lot of details, unfortunately, right now about, if there are any additional partners involved beyond Joshua Kushner and Bob Iger. So it remains to be seen who is supporting this. Do they have private equity? Do they have sovereign wealth? And are there other billionaires in their ownership group?
All right. Bloomberg senior sports reporter Randall Williams with that breaking news just a while ago involving the Los Angeles Lakers, said to be sold for about $12 billion. Now we want to jump to another story, and that is, shares of Wendy's jumping. This after the Financial Times reported that Nelson Peltz' Trion Fund Management preparing a bid to take the burger chain private. Bloomberg Deals editor Matt Monks, you've been following this story. Wendy's has been under a lot of pressure for a variety of reasons. What exactly is Nelson Peltz up to here?
So he's been in the stock since February, saying that he wants to take it private. Even going longer back to 2022, he's expressed interest in this company. And so what's happening is, in hat tip to the FT, he's putting together a consortium, Blue 5 Group from Abu Dhabi, and an outfit called Fling Group, which is their major franchisee, to get together to line up the financing to finally take Wendy's private, which has been struggling with declining sales, rising costs, trading at a discount to like McDonald's. Very typical LBO situation.
Very typical LBO situation, but have they actually laid out any sort of path forward as to exactly how they would reinvigorate this business?
They brought in a new CEO. He's doing a turnaround plan. And then the board signaled in the FT report, they're going to be receptive to all offers. What's really interesting about this, though, is this is kind of like a broader trend where you're seeing activists blur the line between M&A and activism. Like we're going to have Ancora on today, right? Who's going to try and buy a piece of H.B. Fuller. Well, it's kind of the similar situation here. The activists kind of get in there and not just be like a catalyst for somebody else to take a thing private, but to participate themselves.
Operational activists.
Yes, that's exactly right.
They like the term. I mean, do we have examples of how that's worked out? Is that traditionally something that can actually be a little bit better?
Oh, yeah, it happens all the time. I mean, Elliott, they're the ones who pioneered this, and they've done a great job. And since then, people have kind of taken that blueprint and kind of played with it.
Absolutely. Matt Monk's there, of course, with the look at that potential deal involving Wendy's. Now we want to turn right now to our Bloomberg senior deals reporter, Michelle Davis. She's been following another major story involving another major company, and that is Nvidia, looking to combat fears around circular financing. Michelle.
That's right, Romaine. This week, Nvidia unveiling a $500 billion plan for AI infrastructure, and it's tapped 6 of the biggest names in finance to help. The list includes some of the world's biggest asset managers: Apollo, BlackRock, Blackstone, Brookfield, KKR, and Goldman Sachs. The idea is they'll pull together money from third-party investors to help fund the build-out of AI infrastructure. This is by far the biggest AI financing deal to ever hit Wall Street. The exact details on the structure and timing were initially pretty slim, so the news revived concerns that Nvidia is inflating demand for its chips through circular financing agreements. Those worries have helped its credit risk rise. But executives have clarified that Nvidia's contribution will be pretty limited. Instead, these Wall Street firms will independently evaluate each project and decide whether to provide funding. And this probably won't end here, with Morgan Stanley predicting that AI infrastructure spending will be roughly $3.5 trillion over the next 2 years. It's clear companies are having to get creative to find cash for the AI build-out. Romaine?
All right, Michelle, thanks. Now we want to go from that to some high drama in Hollywood. It all surrounds the Paramount-Warner Brothers deal. A person familiar with Paramount's plan saying the board has approved a possible move to actually leave the state of California. And that could actually happen as early as October 1st. But California Attorney General Rob Bonta, he's calling these reported plans blackmail. Josh Sisko covers antitrust for us here at Bloomberg. Josh, what do we know about this? Is this just all kind of politicking, or is Paramount actually serious?
I think there's a lot of politics behind it, but I think Paramount is seriously considering all its options. Yesterday, there was an event in Sacramento where both Rob Bonta, the California AG, and Megan Delrahim, Paramount's head lawyer, who's sort of quarterbacking this for the company, they both spoke separately at this event, and they kind of reiterated these comments. Megan Delrahim, the Paramount lawyer, said that if at all possible, they want to stay in California. David Ellison, CEO, lives there, his family's there, but they have to think about all of their options, is kind of how he framed it.
There's another interesting sort of thing going on right now in the world of antitrust, and it's not as sexy as Hollywood. It involves elevators. Now, this has nothing to do with David Ellison, right?
No, it's that classic combo of elevators and movies, but no, nothing to do with Ellison. Yeah, DOJ, the Justice Department, they opened an investigation into Kone's proposed takeover of TK Elevator, which would create, it's the number 3 and 4 elevator companies in the world, merging to create the world's biggest elevator company. And that size of a deal and the level of, sort of commerce involved sort of is naturally going to draw scrutiny from around the world. And the companies have said they expect to sell assets and are engaged with regulators. But yeah, the Justice Department is now formally investigating the merger, which could take as much as a year or more.
All right, Josh Sisko there with a closer look at 2 potential legal issues there, one involving, of course, Kone, the elevator company, and the other involving Paramount and its bid, of course, to close out that Warner Brothers deal. Now, when we come back, we're going to continue talking deals, and we're going to continue talking about what's been happening in the secondary market. In fact, secondary market volume hitting its strongest first half on record and potentially on track to exceed $250 billion for the full year. Nigel Dawn, the global head of private capital advisory group over at Evercore, he's going to be stopping by the big program in just a second to tell us what he's seeing next. This is Bloomberg Deals. Secondary deals for private assets surging to a record $121 billion in the first half of this year. According to Evercore, that's been driven by fund managers seeking to hold on to single, quote, trophy assets longer. You can see GP-led transactions have not only surged, but also overtaken LP-led transactions in the first half. Nigel Dawn is global head of the private capital advisory group at Evercore, and he joins us now to take a look at the big picture. Nigel, great to have you here.
Terrific to be here today. Good to meet you.
That's a big number for the first half. For the full year, is that number going to be even bigger?
I mean, our view for the full year, we could be 250 billion, maybe 260 billion. assuming there's no, macro global issues coming up.
Well, let's talk about the issues that actually sort of led to this surge. I mean, there's been a lot of talk about the growth of the secondary market.
Yes.
To get to 120 in 6 months and then presumably outpace that almost in the next 6 months. That seems to suggest that there's a lot more going on than just maybe some sort of short-term cyclical development.
I think so. I mean, we see it as a structural change in the market. The secondary market is sort of core market infrastructure right now. Mm-hmm. Well, when I started off 27 years ago in this market, it was a tiny market and sort of ignored. Now, I think like our clients, the largest LPs in the world and GPs, see it as a way to get liquidity in a time where private equity portfolios are really not producing the distributions that limited partners expect.
Well, when we think about private equity and think about the conventional exits, and there's been so much talk about how those conventional exits paths have been, if not shut down, certainly hampered to some degree. If we do start to see a renormalization of those conventional exits, what does that mean for the secondary market and these sort of GP-led investments?
It's a great question. Our view in continuation vehicles, it tends to be the highest conviction asset the GP owns. So it's the one they would like to keep if they could. The next leg of growth they need to finance, so continuation funds tend to be used for them to have the next leg of growth, but it's their best assets. So our view is that this continues to grow and it perhaps even accelerates.
Well, when we get to, say, I don't know, let's say we have this conversation 3 or 4 years from now, is it going to be, this market still going to be that large? The secondary market is going to be larger?
Our view is it's a structural shift in the market, and the secondary market is still only about 2% of the global assets under management. It's tiny.
Wow.
So there's a lot of room for growth. Also, our view is when institutional fundraising comes back and it's been subdued, a lot of that goes into the secondary market. So we feel there's terrific tailwinds in this market.
Well, I'm curious about this idea of trophy assets and the high conviction assets. I mean, I understand the logic of why that would sort of be part of this process, but I would also assume, given the holding period that we've seen on some of these assets, that if they are that pristine or that valuable, why not try to find a more conventional exit?
I think typically it's an asset that the GP can't recreate. And their view is that there's a lot more growth going forward. It may need more capital to finance that growth. So typically in a continuation fund, there's growth capital as well for the next leg of growth.
I am curious, though. I mean, do you have any sense, I mean, just looking through the report you guys put out, of sort of, what proportion of any sort of proposed, like, single asset continuation deals fail to actually attract enough capital?
Yeah. Well, Evercore, we lead the market. Obviously, we're about a 50% market share. We're really fortunate we get to work with the best GPs on the best assets. So our closure rate, is 90%.
Okay.
So our sense is the market is somewhat lower, but I don't exactly know what the close rate is.
How does the continuation funds and their performance compare with traditional buyout funds, particularly when I look at some of the more recent vintages and I'm looking at DPI out of it? I mean, some of those numbers in your own report are relatively low.
Yeah. I think the returns are still being crystallized. Our expectation is they'll be about the same as a traditional buyout, but perhaps with less volatility around the expected return of the individual assets.
But just to be clear here, that when you say it hasn't crystallized, so I mean, these aren't actually sort of realized returns, it's more just kind of mark to market?
Yeah, I think that the continuation funds that were done, 2018, 19, 20, they're becoming crystallized right now. It's the funds since then, and the typical holding period of one of these is 3 to 5 years. Now we're starting to see the liquidity come through from them.
When you talk about this idea of this providing liquidity, there was a lot of talk about a couple years ago about the dry powder that a lot of these funds are sitting on. And we know that dry powder has gone down somewhat here. Is this sort of making up for that?
Our sense is that in the secondary market, there's about 1 year of dry powder. So there's not enough to be abundant, but there's enough to have a competitive market for both buyers and sellers in this market. And the second half of the year, we expect another $150 billion to be raised by the secondary market. So our sense is there is enough capital available.
There's enough capital available. Are there enough assets available, high-quality assets?
Our sense is that there are plenty of high-quality assets. If anything, the constraint right now is capital formation. So when we have more capital, we think that the market grows even further. That's our expectation.
I do have to ask you specifically about what's going on in the software space, because I'm looking at some of the numbers there, and we've seen that the continuation fund volume for software-specific deals is down significantly here. Can you give me any sense as to what the reticence is right now, whether people are just completely on the sidelines, or are they willing, if the seller is willing, to take whatever discount that they can get?
Market's coming back. Our sense is over the second half of the year is going to be busier. Reason the investors have had time to analyze which business models are likely to be durable, which ones are going to be challenged. So when we look at our pipeline, it's pretty healthy in terms of software. So we're feeling pretty. The market is much more selective, though. So I think that's fair to say.
Well, much more selective. I mean, when you look at software deals, I mean, is there sort of a specific sort of model, software model, if you will? There's been a lot made of sort of seat-based pricing and how that could become, if not obsolete, certainly minimized because of the rise of AI and tokenization. Are there certain types of software models that maybe are just less attractive, people are staying away from?
You know, certainly horizontal models, I think, where you could, in a sense that there could be some real disruption. And I think the market's still trying to figure out what happens. Certainly vertical models, there's a lot more interest in, durable models, where there's a sense that AI will actually be an enabler, not a disruptor.
Are you finding, specifically with regards to the appetite right now, from on the GP side? Obviously, we understand their perspective here, but with regards to further transactions involving other parties, is that appetite still there?
We certainly see on the GP side, there is a lot of appetite. I think the analysis around these situations and the diligence is done is probably a little deeper than it used to be. It's not an appetite problem, though.
Okay, but so right now, when you look at pricing and you look at where we are right now in the PE space, are we getting back overall to something that would be called normal? And I understand that this is a structural story and this becomes part of the new normal. But when we talk about price discovery, supply demand, both in terms of investor appetite, but also that mismatch or matchup between capital and assets, is that getting back to normal?
We think it is. I mean, if we look at the buyout market specifically for secondaries, right, that 90% of the GP's last valuation is a good price in the secondary market, and that's where sellers have been selling. So we feel pretty good about that.
All right. Well, Nigel, great to have you here on the program.
Thank you very much. Appreciate it. It's great to be here today.
Absolutely. Love to have you back right here on Bloomberg Deals. Nigel Dawn, Global Head of the Private Capital Advisory Group over at Evercore. Now, coming up here on the program, Goldman Sachs. It's extending its reach into the ETF market with its latest $2.3 billion deal. The shares trading higher, an acquisition that will push Goldman's ETF assets to $130 billion. This is Bloomberg Deals.
I'm Kone-TK. Let's take a look at your midday movers. First up, an inline inflation reading is spurring gains in stocks and bonds, easing concerns about an imminent rate hike. The data is bringing relief to Wall Street traders who are worried about geopolitical risk. S&P 500 hovering near all-time highs. Chip makers and tech stocks are leading the rally. Nasdaq 100 up about 1%. Also, CoreWeave is spurring as AI spending frenzy spurs faster sales growth than anticipated. The firm says a backlog around 100 billion at quarter end. Super Microcomputer shares are up after the company gives a current quarter revenue forecast above estimates, a sign that AI demand indeed continues to bolster server sales. And Wendy's shares soaring on reports Triumph Fund Management is preparing to take the company private. Those were your midday movers. I'm Kone-TK.
Our thanks there to Denitza here as we keep an eye on the broader markets. A bit of a rebound from some of the doldrums that we saw over the last couple of days. The major indices in the green, and you heard her talking about CoreWeave. You heard her talking about Super Micro, and the idea here that there is a little bit more optimism out there here on this Wednesday afternoon for that AI trade. In fact, optical chip makers having a relatively good day. And we should point out a couple of kind of legacy tech companies are going to be reporting after the bell tonight. And that includes Cisco Systems, which has been a big beneficiary here of that shift to the AI space. That's going to be a big conversation coming up after the bell as we cover those markets and get a better sense here of exactly what the investments are in this space and exactly how far they can go. As for the rest of the cross-asset picture, we should point out that yields are down. We did get that CPI report earlier this morning. A read on consumer inflation. Most of the numbers were relatively in line, but it did show that inflation does remain persistent, but there really wasn't necessarily enough in those numbers to really jar the markets in one direction or another. In fact, most bets right now are that the Fed will probably still stay on hold at that September meeting coming up. Remember, we do get another CPI report before then that may provide a little bit more clarity on the inflation picture. But remember, as earnings season starts to wind down, with the only big company left is Nvidia in about a couple of weeks, it's really now a macro story. People are going to be focused on the situation in the Middle East and the Strait of Hormuz. They are going to be focused on what's going on with oil prices. And of course, they're going to be really focused on what Kevin Warsh might do next when it comes to interest rates. Of course, volume is going to start to drop over the next couple of weeks here in the last couple of weeks of August, but could pick up in a big way when we come back in the month of September. A lot more coming up here on Bloomberg Deals. We're going to talk a little bit more about what's been going on with activist investor Ancora Holdings. It has been busy, and it's picked a fight with H.B. Fuller. And, well, we learned a new wrinkle in that fight. It sent out a letter to the chemical company saying that, well, it's actually looking to acquire one of its units. We're going to catch up with Jim Chadwick. He's the president of Ancora Alternatives. He's going to tell us a little bit more in our alternative view. That's coming up next right here on Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Romaine Bostic in today for Danny Berger, and it is time now for an alternative view. And Ancora certainly has one when it comes to H.B. Fuller. The activist investor is pushing to acquire the chemical company's building adhesives unit for as much as $1.2 billion. This after trying to block the company's June takeover of a UK medical products firm. In a letter to the board, Ancora wrote, quote, "We fear your collective preference for entrenchment is once again impairing your judgment and undermining shareholders' best interests. We feel compelled to make our fellow investors aware of your latest instance of seemingly irrational and self-serving behavior." We're joined right now by one of the authors of that letter, Jim Chadwick, the president of Ancora Alternatives. Jim, you definitely got away with words there. Give me a sense here as to where you're trying to go with this.
Look, thanks for having me on, Romaine. It's nice meeting you. I appreciate the opportunity. I mean, essentially, look, and to get to your question, where we're trying to go with it, I think just kind of to set the table here, we view this as a situation, and why we think this is a win-win for shareholders is that an acquisition of this segment by Ancora would actually inject about $1 billion cash into the company, which really addresses what we think is the most serious issue the company has today, which is leverage. So post AMS, which is the acquisition they announced, you mentioned at the start, that the company will have over 4 times leverage here, over $3 billion in net debt. So this allows them to deal with, in a very material way, the biggest problem the company would have. Secondly, it would allow management to focus on integrating and executing on this AMS acquisition. And thirdly, the BAS segment that we proposed acquiring is one that's lower margin and lower growth, and we think it would be better for it to be outside of that business. But I think in terms of why Ancora, why does it make sense? Some may kind of wonder about that. But look, we're operational activists. We're one of a group of people that do this type of work, and that means leveraging our industry expertise to help take companies private at times. Yeah. And look, we have a deep network here in the Midwest that helps us identify roll-up opportunities. And also, what's very unique about Ancora is we're part of a broader $12 billion or approximately $12 billion asset manager that's even part of a larger parent company network. Yeah. And our proposal today actually has no financing contingency to it as well.
Well, is this proposal actually fully financed? I mean, give me a sense here. Is this an actual formal bid or just a way of putting pressure on the board?
No, I think, look, we're very comfortable with what we have in that offer. That, like I said, we did not include a contingency for a reason. So, we have the ability with our AUM to finance and fund this transaction if that's the direction this goes in, and we're given the opportunity to conduct the diligence we would need as any other buyer would. But look, there's going to be a lot of parties interested in this business. I mean, this is a very unique asset, very unique company that's a conglomerate of adhesives businesses, and we know that this business is probably getting as much attention, I'm saying H.B. Fuller as a whole, probably today as anything we've seen in the chemicals market in a long time.
Well, just to be clear, I mean, have you heard from H.B. Fuller or any of its advisors yet?
No, we've not heard anything yet. I mean, that's what prompted this letter really was, we'd actually had a meeting with them. I believe it was July 7th or 8th. And at that time, we expressed interest in working with it to acquire this segment. They, effectively have not responded to us at all since that time. And we felt like, look, at this point in time, they're not going to move on what we think are the biggest critical issues facing the company. Then we had to apply more pressure here.
Well, you've had a lot of back and forth with them on a variety of things, of course, also with your objections to the Advanced Medical Solutions deal. And we had a chance to actually catch up with the CEO, Celeste Mastin, just a couple of months ago about that. And I want to play just a quick soundbite here where she was kind of defending that deal and the idea that AMS could actually be maybe a growth story for H.B. Fuller. Just take a listen real quick, Jim.
So we are the largest pure play adhesives company in the world, and we have a medical adhesives business deep within our portfolio. What AMS provides us is a platform to expand that adhesives business and set it apart as a fourth division within the company, representing about 10% of revenue and growing at high single digits.
And Jim, I mean, Celeste really kind of characterized this as a growth story for the business. And I am curious if AMS actually ends up being more of a growth story for H.B. Fuller.
It's possible it does. I mean, our objection to AMS wasn't specifically AMS as much as it was that the company had made a pledge on their Q1 call to actually freeze M&A activity to focus on deleveraging. Then they went out and announced a $940 million acquisition like this at a 15 times purchase multiple. It's extremely dilutive, right out of the gate. So that's really the issue. I think, the quality of the AMS asset might be very real and in that respect. And it also exacerbates the need to address the rest of the portfolio, which is why our proposal for BAS should be interesting to them because it does help them solve other issues. If they want to focus on higher growth categories, higher margin categories, then we have a good way to free up capital at the company for them.
Well, that's what I'm curious about, though. I mean, you called the AMS thing reckless, but I mean, looking at the letter today for the BAS unit, effectively, this would actually kind of bolster the AMS deal to a certain extent, would it not?
Yes, it would. I mean, look, we're a shareholder of the company. We want to see the company succeed. We don't make money if Fuller fails. And so, ultimately, I think seeing AMS now that today, I believe they actually had the shareholder vote in the UK on that transaction and went through. So this is going to happen, assuming it goes through all the regulatory approvals. And now it's a function of managing these assets, driving the most value they can for the company. So we want to see H.B. Fuller succeed. But look, and I think that hopefully they view this proposal. We realize our tone sometimes is aggressive, but it's something that, whether it's us or others, we think there are plenty of parties that will participate in this.
So you would be okay, based on your current position right now, that if another buyer swooped in and said, we'll offer 1.2, 1.3 or whatever billion, basically above your offer, you would be comfortable with that?
Yeah, I mean, potentially, as long as they have the ability to finance it as we do. And if there's a competitive process for this business, we would participate in it. So I think this is a win-win, like I said, for everybody.
Yeah. Well, what happens next if the board actually doesn't engage with you? What's the next step that you're prepared to take?
Look, I think this becomes a broader strategic, activist campaign, which that's not what we look to do. I mean, we're always looking to engage privately, to work constructively behind the scenes. I mean, we did this twice in the last 9 months with companies, which were Americold and recently here with Ashland. In both situations, actually doing something just like that, putting directors into the boardroom and then seeing the share price appreciate. In this circumstance, we started that way with H.B. Fuller, and then they threw us a pretty big curveball here with AMS. But if this is a situation they don't want to address leverage, they don't want to take the necessary steps to whether it's us or others, I mean, to maximize value. I mean, we honestly think they should explore all strategic alternatives, quite honestly. There's a lot of interest in this business. So if they don't want to do any of those things and the stock continues to underperform, then I think as we get to the proxy process, we'll get to the nominating window as we get to the end of the year. We'll start doing this in the conventional sense. I mean, that's always our preference to avoid it. But if we have to, we have a long track record here of running those types of campaigns as well.
All right. All right. Thank Jim. We got to leave it there. Really appreciate you joining us here. We'll catch up with you again soon, I'm sure. Jim Chadwick there, president of Ancora Alternatives, fresh off that letter, effectively a bid here for the BAS unit of H.B. Fuller. Now, coming up next, well, big news that we just learned just a few moments ago that Josh Kushner and Disney's Bob Iger are set to buy the L.A. Lakers for more than $12 billion based on reporting done by various sources, including ESPN and Bloomberg. This would be the biggest deal ever for control of a sports team. We're going to have more on the world of sports deal making with our investment committee next. This is Bloomberg Deals. And this is Bloomberg Deals. Bloomberg Deals senior reporter Michelle Dave is still with us, and she's been following the latest deals in the sports industry. And Michelle, there's a big one out there.
That's right, Romaine. The world of sports has become a multi-trillion-dollar industry, and teams continue to change hands at huge valuations. Earlier today, news broke that Josh Kushner and Disney's Bob Iger are buying the LA Lakers for reportedly $12.5 billion in what will be the biggest deal ever for a sports team. They're buying the iconic basketball team from Guggenheim CEO Mark Walter, and his $10 billion purchase of the team last year held the previous record for most ever paid. Compare that to the Seattle Seahawks, which were just sold in a deal reportedly valued at more than $9 billion. To put this all into context, Sportico today came out with its annual U.S. rankings, with the Cowboys, Rams, Giants, and Warriors topping the list. Beyond the U.S., this week reports surfaced that Jeff Bezos and other investors are close to buying a piece of Liverpool Football Club from the owner of the Boston Red Sox. The minority stake would value the English soccer team at about $8 billion, and this would be Bezos' first foray into sports ownership. And with so much excitement around live sports, the question now is, where will the money go from here? Romaine.
All right. Well, Michelle, I think we have two people who can answer that better than anyone. That brings us to this week's investment committee, where we take you into the boardroom debates in real time. And joining us right now is George Pyne, the CEO and founder of Bruin Capital. And also joining us is Kara Nortman, co-founder of Angel City Football Club and co-founder of the Monarch Collective. Great to have both of you here. And Kara, I got to start with you because obviously you've made a big investment in a WNBA franchise team at what was then considered a pretty eye-popping value. I just got to get your thoughts here on the latest news about the Los Angeles Lakers, the deal potentially valued at $12 billion, the most ever for a single sports franchise.
Well, I think it speaks to the uniqueness of these assets, right? They're scarce assets. It's one of the few things we do in life that makes us feel human these days, gathering in person to watch these games. The Lakers are obviously an iconic franchise, the team I grew up watching as well. But I mean, it is really interesting, right? It sold, I believe, a year ago for $10 billion. So it's gone up quite a bit in even a year. But I think in some ways we look at these experiences as almost like unique IP. And no one knows that better than Bob Iger, given his years running Disney. And Los Angeles obviously is one of the biggest markets in the world. So I think it shows the fundamentals of the strongest sports teams and leagues will continue to drive, kind of outcomes for a long period of time.
Well, George, I want to bring you into this conversation because obviously the value of these teams goes beyond just what they put on the court or the field. It's the whole ecosystem around it. And of course, when you see a guy like Bob Iger associated, your first thought is, okay, there's going to be a big media business, bigger than what the Lakers already have, probably that's going to crop up if this deal goes through.
Well, right. And you're seeing sports really further differentiate itself in terms of entertainment. Entertainment streaming has been commoditized because there's so much to choose from. And then when you think about artificial intelligence, entertainment's being disrupted by artificial intelligence, sports will be enhanced. So sports has real tailwinds right now that it's never really had before, and you're seeing it in the valuations. And of course, it's a very safe investment. So if you're looking to put investments into sports teams, they're safe, they're predictable, and they've performed over a long period of time.
With that performance, no concerns about that performance maybe slowing down at all? Is this just the future that we're in right now where sports is everything?
Well, I just think sports is pretty predictable. And again, it's separating, right? Because entertainment is less special. So there are very few things that bring together hundreds of millions, in the case of 1.5 to 2 billion people for the World Cup. Very few things can bring people together like that, unifying. So it's an incredible platform that's really separating from everything else.
And Kara, I do want to talk about this idea of just how much sports has broadened out. Here in the U.S., obviously it's NBA, NFL, MLB, and of course maybe the NHL to a smaller degree. But we've seen the proliferation first of men's soccer, now with women's soccer, and your involvement there. The WNBA, which is now really starting to see some significant gains in valuations. And then a lot of niche sports that are, suddenly not niche anymore. How far does this go?
Yeah, well, I mean, Monarch was the first pool of capital to exclusively focus on women's sports. And so we only look at women's sports. And I would say the market growth is disproportionately aggregating to a handful of sports and a handful of leagues. So I think it's really important to note that these assets are very predictable, uncorrelated. There's this unique, the downside is protected by franchise value and the upside can be very significant. But it isn't, not all sports teams and leagues were created equal. So very quickly, the women's sports market wasn't measured when we started Angel City in 2019. 3 years ago, Deloitte measured it for the first time at $500 million, and then more recently at $3 billion, whereas the men's market's $500 billion. So that growth, though, is going disproportionately to women's football or soccer between, here in Europe, women's basketball in the United States, tennis, golf, and then beyond that, the risk profile changes rather significantly.
Give me a sense, though, Kara, too. I mean, we're just coming off of the World Cup. The Women's World Cup is coming up. We've seen the boost, particularly here in the United States, of interest in international football, if you will, coming out of these major events every 4 years. Is this going to be one of those events, particularly not for this year, but for the Women's World Cup, to actually maybe give a further boost to the NWSL and Major League Soccer?
I'm like a giddy kid right now, to be honest. I mean, I think obviously I'm spending my life on this topic, but football or soccer, both women's and men's, I think, is a joy creator and a purpose creator. And so returns are there, but also joy is there. But I would say 100% yes. MLS and NWSL are meaningfully up. We're preparing for Brazil next year and World Cup 31 in the United States. And I think what you've seen across the board is interest kind of surge. One quick note, the U.S. women's national team got 25 million viewers in 2015 for their final in Vancouver, which is pretty similar to what the men's team got this time around, but yet people are paying a bit more attention to it. And so I think the key thing to note is how are the stadiums, the viewership, the fan experience, the ability to connect on an ongoing basis set up, and the infrastructure is now there. So it's the world's most popular sport, and I think you're going to see it explode.
Well, George, talk a little bit more about that infrastructure as well, because you heavily invest in kind of, I guess, what's on the periphery of the field, not necessarily the players and the teams, but all the things they depend on to actually pull those games off.
Right. And those services are more important and more expansive, so they could be stadiums. We own companies that put the field in. They also light the field. So it's a wide array. And those services become more important to investors because they need to get returns on their investments. So it's broader, international. We operate in 103 countries. And so these services, best in class, are important to make the fan experience better, but also make the investment better for the owners.
I think it's interesting. Both you and Kara have kind of kicked in the door in a lot of ways. Her being kind of the first PE investment in the WNBA, you creating the first kind of sports-only, sports-dedicated PE fund here. Are there still doors out there, though, maybe that still need to be kicked in?
Well, I think so.
Yeah.
I think even, when you look at what the Yankees did this week with Apollo, which was a combination of credit and debt, and I think when you look at 6th Street and the Ares, the credit side of sports is still relatively new in terms of its conservatism. So I think what you're seeing is a very dynamic industry rolling out all kinds of different applications in terms of investment opportunities.
Well, Kara, I want to get your thoughts on that as well, because now that we see the leagues embracing private capital a little bit more to an extent, do you anticipate that we will continue to maybe see that grow, meaning what the league will allow in terms of percent ownership of limited partners and outside investors?
I mean, I think in some ways I describe women's sports leagues as like if you were going to rebuild democracy right now, studying a democracy that's been in place for 250 years, what would you do? What would you replicate? What would you change? So I think you're going to continue to see, I mean, women's sports, we have 5 teams now. We're investors in 5 teams in 2 countries and 2 sports and 1 rights-based business. And you're seeing leagues innovate in very different ways, where in some cases they're pulling in best practices, and in other cases they're leading and doing things differently. In women's sports, we have a kind of a different set of opportunities, which is really operationalizing and bringing in excellence on the talent side, partnering with brands to launch in new ways, right? Beauty brands are coming in for the first time, et cetera, and then building infrastructure. And that's accelerated, I think, much faster than it has in men's sports. So it's a little bit of both, best practices and where are we setting the stage and doing unique things that men's sports maybe hasn't tried yet.
All right. Unfortunately, we got to go. This conversation way too short. That is our investment committee today. Kara Nortman, co-founder of Angel City Football Club and founder of the Monarch Collective, and George Pyne, CEO and founder of Bruin Capital. Thanks to both of you. All right, coming up, a smaller deal, but well, one that's going to be talked about a lot. Popular podcaster Alex Cooper just got a $500 million valuation for her media company, Unwell. That's the name of it. That's thanks to a major Hollywood investor. We'll take a closer look up next on Bloomberg Deals. Popular podcast host Alex Cooper's media company. It's called Unwell, and well, it's actually doing well. It just got an investment from Hollywood super agent Patrick Weitzel, valuing the firm at $500 million, according to people familiar with the matter. Well, let's talk to one of our reporters here who knows some of those people familiar with the matter. Ashley Carmen is following the story, and she joins us for more. This is a big deal. I mean, we're talking about a person who, a few years ago was just her and her buddy was, sitting there in their house doing a podcast, and now she's got a $500 million company, if you believe this valuation. What do we know?
Well, I mean, yes, Alex has been building a media company, Unwell, with her husband, Matt Kaplan. They've very much tried to get away from just being a podcast company. Mm-hmm. So they have expanded into beverages. They now have an ad agency that Alex has said is going to eventually rival the podcast as far as revenue coming in. They're partnering with third-party creators. I mean, they're really trying to make this into a holistic media company, which is what I think this investment really speaks to.
Give me a sense of what we know about the investor. I mean, we list him as Hollywood super agent.
Yeah.
What's he do?
Ben Affleck and Matt Damon, 2 of his biggest
Not
clients.
Yeah.
Definitely someone who's known to be able to identify talent and help them grow into mega stars and build businesses around themselves. So it really is a vote of confidence in Alex and what she's building.
And she's done other media, not just podcasts, but she's done some TV shows and specials like that as well.
Yes, so her husband, Matt, who again runs the company with her, he is a Hollywood producer. And so when they started going into business together, / their relationship together, that was one of the spokes of their business, was to make shows for big Hollywood streamers like Netflix, Hulu. They put some shows on YouTube, things like that.
All right, Ashley Carmen there with Bloomberg News, taking a closer look at that new deal. Alex Cooper, Call Her Daddy hosts her media company, valued right now at $500 million. That is a deal. And that does it for Bloomberg Deals. To stay up to speed even after the show, guess what? You can subscribe to the Bloomberg Deals newsletter by typing in all that stuff at the bottom of your screen there. For all your political news, stick around. Balance of Power coming up next, live from Washington on Bloomberg.